Cost element accounting is the first step on the way to breaking down all costs incurred so that we have the costs for the individual cost units at the end of the day, i.e., we know how high the costs are for a product, a service, or an order. To do this, we first need to record all operating costs for the period in cost element accounting. We are guided here by the question, what costs were incurred and how can they be broken down into categories? In some cases, this categorization has already taken place in financial accounting, as individual accounts for materials, wages, or even rent and depreciation already exist here. In cost element accounting, the expense items of the profit and loss account are transferred to the cost items. This is done in the so-called operating reconciliation sheet. In the first step, we take the expenses from the income statement and analyze each item according to the following aspects. Firstly, is it operationally related, due to operational reasons, meaning that it is related to the core business of the company? Secondly, does it occur regularly? Is it something that occurs on a regular basis, i.e., is it nothing out of the ordinary neither in terms of type nor amount, and is it on an accrual or periodic basis, in terms of time? Have all expenses also been incurred in the current period? Does it not include anything that actually happened last year but was only posted this year? And what about the valuation? Is there consistent valuation, an equal valuation, between financial accounting and cost accounting? Therefore, all expenses should correspond to the actual current and realistic values in terms of content and amount. In other words, no changes should have been made that are unrealistic in terms of amount due to the use of legal tax leeway or that have been distorted due to legal valuation principles. If we can answer yes to these 4 points, meaning that it is operationally related, orderly, period-specific, and follows a consistent valuation approach, then it is referred to as purpose expense or fundamental costs, meaning that expense is equivalent to cost. If the answer is no, even to just one of these points, then we refer to these as neutral expenses, which should not be transferred from financial accounting to cost accounting. Furthermore, the concept of imputed costs still needs to be clarified. These are costs that are offset by expenses of a different amount in financial accounting, for example, in valuation systems. We then refer to these as other costs, such as balance sheet depreciation or accounting depreciation. Is the neutral expense if a different useful life were to be applied more realistically? This means that imputed depreciation could be included under the cost item, or additional costs could also be included if no expense is or may be recorded in the accounts, as in the case of a contractor's wages, for example. This is because in cost accounting we can enter costs freely and without legal barriers. We just want to have values for our subsequent calculation of the products that are as realistic as possible for our internal control. Let's take a look at the cost type calculation using an example. We have a copy shop here and we look at the profit and loss account from the financial accounting. We see sales revenues of 200,000 euros but also various expense items listed here. And it is precisely these expense items that we now transfer to a separate table for the operating reconciliation. As you can see, we have simply introduced material, personnel, depreciation, other expenses and interest. In total, these expenses amount to 124,000 euros and we are now carrying out a so-called operating reconciliation. In other words, we decide whether these expenses also represent financial accounting costs. So please remind yourself of these 4 aspects. Is everything that is included properly accrued for operational reasons, i.e., does it fit in terms of time? And what about the valuations? In our example, we only have a 100% match in other expenses. In other words, the expense is also 100% cost. For all other items, something had to be neutralized or costs had to be applied differently. We have also listed an item here, the imputed contractor's wage, which represents so-called additional costs. For example, it could be that the materials were purchased at an original value of 80,000 euros. Now, however, we would have a replacement value of 85,000 euros. If we were to purchase the same materials, since we want to use the data for our calculation, we use the current value of the materials. Now we have converted all the expensive costs. The last step in cost element accounting is to split or allocate them into direct and overhead costs as well as fixed and variable costs. Direct and overhead costs differ in the way they can be allocated to the cost object, i.e. the end product. In our case, these are copies. We are a copy store, which is why it is quite clear that materials such as paper and toner are direct costs. But all other items such as personnel, depreciation or other expenses cannot be directly allocated to the cost object and are therefore assigned to the overhead costs category. Finally, the division into fixed and variable costs. As a reminder, variable costs develop in proportion to the quantity or the amount of work, i.e. the more copies are made, the more material, i.e. paper and toner, is consumed. Variable costs are always the same for a single item, while fixed costs are always the same in absolute terms, i.e. for the total quantity. For example, personnel costs. Regardless of how much is copied, the employees always receive the same wages, but their importance per item decreases as the quantity increases. So the more that is copied, the lower the proportion of staff per copy. In our example, we clearly have variable costs for materials. Personnel costs, as well as interest and imputed contractor wages, are generally regarded as fixed costs. We have a special case here with other expenses. The €7,000 includes a part that is variable, but also a part that is fixed. For example, electricity costs are included here depending on consumption. These naturally vary with the number of copies. Whereas the rent, for example, is fixed every month, i.e. the same amount every month, regardless of how many or how few customers come to the copy store. Next comes the cost center accounting, where only the overhead costs of the cost types are accounted for and further analyzed. The direct costs are transferred directly to the cost object accounting.